A research study conducted at the University of Arizona by marketing professor Anastasia Ghosh involved questioning consumers about which method of spending made them feel the most guilty. Ghosh had assumed people would tend to reserve buy now, pay later payment methods for one-off luxury items until a control group of younger participants in one of her studies happily used it to pay for groceries and felt absolutely nothing negative about it, which blew my mind, she said. The study demonstrated that while older consumers might see paying for bread and milk with installments as a sign of financial insecurity, many young people find it liberating. And this is part of the reason why buy now, pay later has become one of the fastest growing forms of debt in human history. But there's one very big problem. This debt is invisible. And it's on track to be like the subprime mortgage crises in 2007, a time when the general public was unaware of the explosion of high-risk mortgages hidden in the banking system until banks started collapsing one by one, causing a terrible credit crisis and destroying the entire global economy in the process. The exact same thing is happening again. The buy now, pay later debt bubble is quietly growing at record speed while no one is paying attention. The only difference is that this time it's much worse. In a few short years, buy now, pay later financial technologies like Affirm, Afterpay and Klarna have infiltrated nearly every corner of online shopping and retail. People are buying table lamps, TVs, and even groceries with this kind of financing. However, this new credit option isn't just invisible. It comes with a staggering amount of terrible risks that most consumers are unaware of, and the impending financial nightmare that's in store for unassuming buy now, pay later consumers is truly devastating. BNPLs, or buy now, pay later loans, are short-term loans that allow customers to pay for everyday items in installments with few eligibility checks, and usually with no interest. Americans have been used to something called layaway since the Great Depression. This essentially meant that you could pay for an item in installments, and then finally be allowed to take it home from the store once you finished making all the payments. However, today's buy now, pay later plans switch things up, so rather than owning an item and being able to take it home only after you've paid in full, customers can get the product immediately after making just a small deposit and conducting very basic credit checks. These payment methods skyrocketed in popularity after 2020, mostly because of the financial difficulties that many people faced during the financial chaos and uncertainty at the time, but also because many more online retailers embraced the schemes when online retail boomed during that period. In fact, it was during the summer of 2020, in the height of the global shutdowns, that Americans used Affirm to buy so many Peloton products that Peloton alone accounted for 30% of Affirm's total revenue in the quarter ending September 2020. Affirm has since got into partnerships with Amazon, Walmart, Target, Nike, Shopify, and many more e-commerce giants. From 2019 to 2021, the total value of buy now, pay later loans in just the United States went from $2 to $24.2 billion. But what's surprising and completely unexpected is that it's heavily popular with a specific demographic that drive almost all of its revenue. In fact, a review commissioned by the Financial Conduct Authority found that pay later technologies are particularly attractive to younger people, as around 75% of customers are reported to be under 36, and even more interesting is that the majority of those are female. Aside from being incredibly popular among young women, another interesting fact is that the majority of buy now, pay later users also don't have or don't use a credit card. To many Gen Zers, using this form of payment seems less risky than credit cards because buy now, pay later payments are usually fixed to a few weeks with 0% interest. And they might have a point. Credit card companies generate the majority of their profits from customers who miss their payment deadline or only make minimum monthly payments. And yes, traditional credit card providers have been known to keep people in debt with extortionate interest rates and fees because the majority of users only make the minimum monthly payment. In fact, according to a McKinsey survey, roughly 60% of credit card holders do not pay the full credit card bill each month. This is why fixed pay later installments give people a sense of security, because the debt from a purchase won't increase rapidly like credit cards, where the high interest rate quickly inflates the loan into a much bigger debt that takes forever to repay. Social media influencers on places like TikTok also feed into buy now, pay later's popularity with completely unrealistic hacks that just feed into its appeal. For instance, there are TikTokers that suggest people use buy now, pay later as a clever strategy to avoid paying the total price for a product up front and then invest the remaining payments until the next installment is due. That way you can earn money on your purchases through your short-term investment, since these loans often have zero interest payments and no fees as long as they are paid on time. Although this makes economic sense, it's not at all practical. First of all, investments don't typically yield decent returns within the 6-week period that most buy now, pay later payments are due. And even if they did, most consumers who are using a loan to buy a $20 product are unlikely to buy stocks or bonds with the outstanding installment amount. In fact, they are just as likely to spend it on something else. The type of person that would invest their installment payment in the stock market, yet still makes that same payment by its due date, would most likely already be investing in much more effective ways. In practice, these type of pay later options are increasingly used for grocery shopping and even utility bills, not the non-essential purchases like fashion, gadgets and beauty products that they were originally designed and marketed for. This just shows that they are in fact being used as a way to financially cope for people who are already in a bad financial situation. But the real question is, how do buy now, pay later companies actually make money if they are loaning out money at 0% interest? Well, in simple terms, buy now, pay later providers can offer 0% interest rates because they charge merchants 3 to 4 times the average credit card processing fee. It is easy for them to get commissions direct from the retailer because of the enormous benefits of using popular pay later technologies, and importantly, these services are effective at increasing sales. Companies that offer buy now, pay later payment options are happy to pay the extra fee to have these options available on their site, because customers are more likely to buy something, spend more, and less likely to abandon their online shopping cart when given the option to pay in installments at a 0% interest rate. But hidden beneath the surface are serious problems that most people don't even realize exist. Because these technologies are still relatively new, they also lack a certain amount of regulation, and this increases risk to shoppers. Buy now, pay later providers are not subject to the same regulations as traditional lenders, and consumer protections for this industry are few and far between. In fact, more than a quarter of people who have used a pay later payment method reported having at least one problem, like being overcharged or trouble getting refunds. There are also other rarely discussed risks to consider when using these types of payment methods. For instance, buy now, pay later lenders typically want you to give them information about your checking account, but this is highly sensitive information to give away, and it puts you at risk of data breaches. And even though they are usually sold as a zero-interest credit loan, they expose users to lots of additional hidden fees. For instance, an average loan of $135 will receive a missed payment late fee of about $7. This represents an APR of approximately 62.28%, while the average APR on a credit card is usually between 20 to 30%, and other forms of traditional credit have an APR that is even much lower. The Consumer Financial Protection Bureau said they are very concerned about how unclear the terms of these types of loans can be, as well as how these programs can cause consumers to build up lots of debt. This is because you could have thousands of dollars of debt on your balance sheet that nobody knows about, because most of the companies don't provide any data to agencies. The result of this is that formal lenders like banks currently have no way of knowing what buy now, pay later debt a person is carrying. This is very dangerous for traditional lenders because they might be taking on a lot more risk than they are aware of, and this could be happening on a wide scale without anyone knowing. And because pay later loans do not send data to credit agencies, they do not help you build or improve your credit. However, even though they can't boost your credit rating, they can definitely destroy it. This is because lenders may send any debt that you fail to pay to a collection agency, which is an activity that is usually reported to credit bureaus and hurts your credit score. Most people typically have just a few credit cards, making it easier to keep track of payments, but buy now, pay later users, on the other hand, usually take out loans from multiple places, which just makes it difficult for them to keep track of all the purchases they've made. It's not unusual for someone to have pay later loans from 15 different places at one time. In fact, consumer reports have found that people who owe 4 or more loans at once were twice as likely to miss a payment as people with fewer loans. And this is partly why buy now, pay later loans increase consumer debt, because people are more likely to take on additional debt if they know they can spread out the payments, and it's so easy for people to bury themselves in low monthly payments. And this leads on to what is by far the biggest problem, which is something called phantom debt. Phantom debt comes from the fact that these loans can lead people to build up a significant amount of debt without realizing it. Managing multiple loans and many different repayment dates is extremely difficult for most people, and because this phantom debt is not recorded by debt reporting agencies, it could be creating a large debt bubble that is far bigger than anything that we've seen in recent history, but because it doesn't show up on a centralized reporting system like other forms of debt, no one will be aware of it until it reaches a crisis point. Since debt agencies are under-reporting debt information because they lack data from buy now, pay later lenders, traditional lenders could be taking on more risk than they are prepared for. The worrying part is that the crisis point might be much closer than you think. Some experts claim that buy now, pay later delinquency rates are already overtaking those of credit cards, and young buy now, pay later users under 25 have the highest default and delinquency rates. Only around 40% of Klarna's customers pay on time and in full or before their due date. Plus, this particular payment method increases the likelihood of borrowers dipping into their savings. And in the summer of 2022, Citizens Advice in the UK found that 42% of people who had used a pay later loan were using credit cards or borrowing from other sources to make their repayments. And this is by far the most devastating problem with buy now, pay later loans that create mountains of invisible debt quietly snowballing without anyone being able to quantify just how big the problem is. Until it's too late. But it's much worse because on paper people who borrow from these financial technology firms look as creditworthy as the people who qualify for conventional loans, but the truth is buy now, pay later users are much more likely to default. Buy now, pay later companies promise a more liberating and enlightened form of lending, but it is starting to look very much like the beginning of another boom-bust debt cycle. Meanwhile, many Americans are relying more and more on these new lending methods for everyday necessities like bills and groceries, while struggling to keep track of all the debt they have and defaulting at a record rate.